Good morning, good afternoon, or good evening to everyone that is joining us today. I'm just going to perhaps just wait for a minute or two for people to come on, and we'll check with our administrator to give me the green light to get started. So if you could just bear with us for just a moment. Just confirming that you have joined the webinar, What Carbon Means for Farmers. This will run for the next 60 minutes, so we'll close out just before 12 p.m. here in Australian Western Standard Time, or wherever you are an hour later. Just for those that have joined, just to let you know that we do have the chat. Unfortunately, for this type of webinar, we don't have the ability to have people come on and off camera, but we'll be fielding questions via the chat box. And so please, I've just dropped a note there. Any questions, or if you'd like to say hi from where you are in the world, that would be good as well. Okay, I understand we've got about 40 people online. Okay, I think we're ready to go. So the tech is so far working. So a big welcome to everyone that has joined us. We've got a few things to talk about today, and but we'd like to keep this as conversational, as engaging as possible for you. So I have also brought on some of my colleagues. Testing. I think I'm back on, yes? Okay, good. Just as I said, the technology is working. My headphones ran out of battery, so joy. Um, so thank you for joining. This webinar is, as you know, what carbon means for farmers. Just letting you know that we've run this session twice before in person in the regions. First in Dalwallanu in February, and then secondly in Manjimup last month. So we thought we'd bring this to an online audience so people could actually join from wherever they are, to essentially engage into the conversation around what what carbon does mean for farmers. But first of all, introduction. My name is Catherine Bell. I lead the ESG and Climate Services practice in Western Australia. I also do co-lead RSM's ESG hub across Asia Pacific as well. Ultimately, our team, we're responsible for helping companies of all sizes help integrate environmental, social governance, ESG, and also climate into their organisations. Obviously, we're hearing a lot more about this, and it's becoming quite the business imperative to understand what this means for various businesses and yourselves as well. So, in addition, we obviously help with the accounting of non-financial, which does include carbon accounting or greenhouse gas emissions, which is becoming increasingly the norm for businesses to have to calculate. And this is why we're here today, sort of to really talk about what does the various meanings of carbon, what does it mean for farmers? Because there are various ways to skin a cat, as they say, and we wanted to ensure that there's sort of clear understanding of what the options are and what does it mean. So quickly, just to note that this is RSM, and why do we talk a lot in the agribusiness space, primarily because we have such a large presence across regional Australia, and we do spend a lot of time with regional businesses, agribusiness and farmers in helping them with their businesses from an accounting point of view. And so that's some of the services that we do offer. And I've just noted there, and now ESG and carbon accounting. So this is just another service that we are adding on to the business advisory and tax to help businesses in the regions understand what they need to account for. So before I get to introducing my colleagues, I just wanted to sort of run through what we were going to cover today. It's always good to start at the top, at the very beginning, and sort of answer the questions of why are we here, why are we talking about carbon? So really touching on some of the mega trends that are happening across the agricultural space, not just here in Australia, but globally as well. And that then leads into these new climate reporting changes that are happening in Australia that have become mandatory as of 1 January this year. This is having a massive impact on the Australian market, not just in the agri industry, but in all sectors. And so I'll talk through some of what those changes are and what are the impacts to business are and what sort of essentially is just over the hill and how we can help prepare businesses for this change. And then the third section is we wanted to sort of break down what carbon does mean for farmers. And we've broken it down into your carbon footprint, meaning the carbon and the emissions that a farm actually emits. And then what is carbon as a business? So carbon farming, and we'll talk about that a little bit more. And then the third part is we really want to talk about this broader holistic understanding of ESG or sustainability in farming and what does that mean? Because they're all interlinked but mean slightly different things. And it's important that we are quite clear on the differences because that means farming clients or businesses can lean into what really is meaningful for them and what makes sense for them. And then what next is just sort of, we'll just touch on how we help businesses, but also some of the things that you may want to keep in mind, some key takeaways going forward. So, who's on the call? Myself, Catherine, I've introduced myself, but I will just hand over to Nathan Walters, who is our Director of Business Advisory, and he's based in Manjimup. And we've also got Nikki who's a manager in our ESG and Climate Services team, and she's based in beautiful Margaret River. So I might hand over to Nathan just to say hello and maybe just talk a little bit about what you do and your, I guess, understanding of what we're talking about today.
No worries. Thanks very much, Kath, and thank you to everyone for joining the call today and giving up your time to learn a little bit about what carbon means for farmers. As it says there, I'm a director of RSM based in Manjimup. Been here for 25 years in the office. I'm actually a born and bred, raised in Manjimup, so grown up on the farm. So I've got deep roots in country and agriculture. So it's very important to me, and this has a direct effect on my family, but also my clients that are based around the area as well. Obviously, being based in Mandurah, we are specifically agricultural based, so quite prevalent for this conversation and this topic. And to throw into there, I'm also the director in assistance of our national agri sector for RSM. So from here we're taking this national as well to go through, not just WA regional. Um, just as Kath's been talking about, it's the what does carbon mean for farmers? It's starting to become more prevalent for our clients at the moment. We're starting to get questions about it, so it's increasingly important to get knowledge and knowledge and information is power. So enjoy the webinar. Please be involved as possible as you can. Ask questions, and we can hopefully share some of the Kath's wisdom to everybody else in there. Over to you, Nikki.
Collective wisdom, Nathan. Thank you. Collective. Thanks, Nikki.
Thanks, Catherine. Nathan. So I work in the Sydney office, from the Sydney office, but I'm actually based remotely in Margaret River. So I do a lot of work out in the regions, but also I work nationally, doing a lot of auditing for carbon farming projects and other ESG and sustainability programs. I came to RSM a couple of months ago from my previous role, which was with a carbon service provider, and worked closely on a number of carbon farming projects with landholders. And prior to that, I've worked a lot in organizational sustainability, particularly around organizational carbon footprint, measuring emissions and trying to work out ways to reduce emissions. So it's very relevant to the agricultural sector, and I'm very happy to be here today. Thanks, Catherine.
Brilliant. Thanks, Nikki. And again, please, having Nathan and Nikki on the call, direct any questions to either of those two throughout the session. I've got the chat open, so in the event, I'll try and pick up questions. If we don't get to them, then we'll address them in the post-event comms. So I'm going to kick off now, really just to kind of go back to that, why did we actually create this presentation in the first place? I do understand there's probably a number of people on this call that some will have a greater amount of knowledge around carbon versus some that are just perhaps just entering in and just trying to find out information. So we're trying to find a nice balance between providing some valuable information across the spectrum of knowledge abilities. So, but just we were finding that carbon footprint, which is measuring the carbon emissions that occur as a result of farming activities, such as methane produced by cattle or cars driven on site, versus carbon farming, was where we were getting people interchanging that use. And I think as the market and matures, this is obviously becoming clearer, but really we just wanted to unpack all the various ways in which the new, I guess we call it this transformation of the market and changing market landscape, and this introduction of carbon, and why it's becoming so important to so many businesses. What does it mean for those farms? And so carbon farming is those activities that contribute to sequestering or removing carbon, which can create ACCUs, so carbon credits, which can be sold and can be used as a revenue generation for a property. So we're going to concentrate on those two specifically in this, but we're going to sort of round it out with the sort of broader economic and operational kind of opportunities for farming clients. Why is RSM talking about this? And this was partly an addition to the slide deck after we presented this in Manjimup, and Nathan remembers this well, is that we were getting a lot of people kind of that have been hearing about carbon and, oh, they must do this, and sort of this lecturing of sorts. And we didn't want to, that was never our intention, is to come and lecture about sustainability and climate change and all these sorts of hotly contested topics. Unfortunately, it was more around, as business advisors, RSM has a duty to our clients to help them understand what is on the horizon and help their businesses prepare. And so just like this list of accounting changes that have happened over, since 2000, whether it be the introduction of the GST or whether it's JobKeeper or COVID-related relief, RSM business advisors are there to help businesses traverse and essentially evolve to what is just an evolving business landscape. And increasingly now, with the introduction of the climate related risk reporting, which I'll talk a lot more in a moment, it's presenting a real transition for organisations of all sizes, and it's having a domino effect across all markets. And so it's not happening just in the agribusiness sector, it's happening in all sectors, but some sectors it's having a larger impact versus other sectors. So, but the agri sector is a cornerstone sort of sector because it's there's so many things going on right now, and that's where I'll talk to now in terms of these top challenges for agriculture are not small, and what they also represent is a confluence of risk that's occurring not just here in Australia, but happening at a global level. So climate change is obviously the one that we're hearing a lot about in the media. We've just had an election and probably a larger windfall of Labor winning that as a result of their stance on climate change. also following behind climate change is nature loss. And we know that this is going to have, they're almost two sides of the one coin, and they are intricately linked in terms of the impact that they have. So the more the climate changes, the more impact on nature that occurs. And with 50% of our global GDP that is linked to nature, what that means is that it will have an impact on our economies and it will have an impact on our businesses. And we need to look at preserving and not just preserving our environment that provides us with those the natural capital to run those businesses, but we also need to protect jobs and our economies and our communities. As a result of nature loss, invasive species are a problem. The environment, again, is, we have to balance productivity with environmental stewardship. Increasing populations and is obviously increasing food requirements is a challenge there. So trade-offs is something we talk a lot about in sustainability. There is never going to be a silver bullet for anything, and we do need to work on trade-offs going forward. Rising costs, as we know, we've come through an inflationary period where global supply chains are being pinched, and that's putting pressure on prices for fertilizers, machinery, and that's affecting margins, obviously. So that's happening not just in the agricultural sector, but globally, rising costs are a problem. I've tried to tag here, what's climate change versus, carbon business, and then what's related to carbon footprint aspects of the presentation. But the green highlighted boxes is really this where the new climate related disclosures have come in, and the need for businesses to transform or transition and to these new metrics around reporting, because it will mean market access. So if you're unable to present information to your suppliers or provide some sort of ability to demonstrate that you're integrating, let's say, ESG or sustainability into your business, then the rules permission to play or the social license to operate, meaning you may not be able to sell your product one way or another. And that's because regulation is driving these requirements from the top end. And we'll look at that in a bit more detail now. And I was just going to say, Nathan, Nikki, if you wanted to jump in any comments on anything I was saying, just to round off, feel free. So these macro trends are obviously manifesting across the market, here in Australia in physical risks with flooding, regulatory risks with, markets kind of suddenly deciding that they can't take particular products. As Queensland beef exports were recently threatened due to new laws that are being introduced across the EU. What are some of these physical risks and events having on our produce, whether it's wildfires on wine? The one to also watch is obviously consumer demand. As more consumers become conscious around sustainability, the environment and climate, they have their purchasing power to make decisions. And so this is driving the emergence of new products, and we call this a transition risk. And one way to sort of look at the transition risk, I always use the example of Kodak, which is like the Kodak moment where, they didn't see the digital transformation happening. So I kind of liken this to the sustainability transformation, where really, the whole system is changing from the energy system, which has been completely uprooted, to the products and services that fall off of that. And so, based on the the assumption or the reality of that our consumption and production patterns to date have not been sustainable, there needs to be a rewriting of those. And this is essentially occurring through through finance and through reporting. And we'll talk to that in a minute. But the one box on the right-hand side, which is obviously which is highlighted in red, is the one that most of you probably have heard about, and we'll see more of this, and that is the example that Coles did come out in August 2023 and said that it's going to partner with, I think, 75% of its suppliers to set science-based targets. And this is really to help Coles hit their targets, and they have commitments around reducing their carbon emissions, which means that they are looking to leverage and drive that target down to their suppliers. And so this is a case in point where the large retailers are looking to engage and essentially partner with them to provide this kind of impetuous to essentially drive and find ways in which they can essentially together impact their carbon emissions. So a little bit more about that as well going forward. So the biggest change in corporate reporting in a generation is here. This is what the introduction of non-financial reporting is being flagged as. And this is where we're seeing the merging of financial reporting and non-financial reporting coming together. So the introduction here in Australia of what we call the AASB S2, which is climate-related reporting, is essentially has come from IFRS reporting, which is the International Financial Reporting of Sustainability. And we're basically introducing it here in Australia mandatorily. Mandatorily, that's not a word, it's mandatory. 1 January of this year. And it's going to be phased in based on 3 groups. And to trigger the group 1, you have to have $1 billion in assets, more than $1 billion in assets, or 500 million in revenue, plus 500 employees. So you have to trigger 2 out of those 3, and so forth for group 2 and group 3. So for group 1, it means that FY26 reporting will be your first year of integrated climate risk reporting. The interesting thing here for Australia is they're going very wide, meaning that they're including listed entities, large private, ENGA reporters, financial institutions, and even governments in state and federal will be rolling out similar reporting as well. And not-for-profit large that report under Chapter 2M will also fall into this as well. IFRS is being the same reporting standard is being rolled out globally under IFRS S1, S2. S1 is essentially ESG reporting, S2 is the climate reporting. And they generally, in most countries, as we've written a report for Asia Pacific, are only applying it to listed entities. So this is where Australia is in fact actually leading the charge, rolling it out to large private as well, and then down to these group 3 companies, which which will tip reporting requirements if they have 25 mil or plus 100 employees. So what does it look like in reality? Essentially, what does it look like is that a company will have an annual report, which has been mandatory if they have to report under the Corporations Act. And what's being introduced is this climate-related risk reporting. So that's AASB S2, which is essentially the Australian contextualised version of the IFRS S2. What we've also established is the AASB S1, which mimics the IFRS S1, and currently that is voluntary. But in time, it's the expectation that the sustainability reporting that will form part of the annual report will remain agile and open to include ESG at some point in the future that may become mandatory, and also the introduction of the TNFD, which is the Task Force for Nature-Related Disclosures, like climate. Nature loss is increasingly becoming a major issue or a major threat to financial markets, and so that may be something in the near future that that markets are expecting to be reported on as well. But for now, the focus is really on getting climate reporting right, and reasonable and proportionate to the risk of companies that need to report it. And so, whilst this is happening for the most part at the top end of the market, it does have implications for those businesses, smaller businesses, SMEs, down the line, because a key part of the reporting requirements for the climate, AASB S2, does include carbon emissions of their value chain. So this looks like a very colourful, confusing slide, and I apologise for that, but just what I'll let you know what you need to focus on. The AASB S2 climate reporting, the things that need to be reported are listed down there on the left-hand side. So they need to report on how do they govern climate risk within their organisation. How do they identify risks and opportunities that climate risk and climate change represents to their company, and so forth? And how do they manage those risks? And do they have any transition plans, etc.? Two of the main mandatory reporting requirements as part of this disclosure includes Scope 1 and 2 emissions in their first year, which requires limited assurance. And then in their second year of reporting, will include Scope 3 emissions. And Scope 3 emissions is value chain emissions, and these value chain emissions include small businesses. And this is where the domino effect is happening across the market, and why the pressure is happening not just at the top end of the market as a mandatory reporter, but it's happening across the market in terms of this need to understand where emissions lie in the value chain and where the risks of and their abilities to actually put downward pressure on those emissions. And also just to note that in addition to reporting on climate risk for these organisations, is that the information needs to be assured. And so what that means is that with the assurance of information, there needs to be a chain of evidence to enable the verification of that information for auditors like ourselves, who not only straddle consulting, but we also provide the assurance over this data, is that we actually need to find evidence around appropriateness and effectiveness. And when you calculate emissions, there is a method that is required that needs to be followed to ensure that there's transparency and comparability across the emissions, across companies, across markets. So it's really important that companies follow a particular methodology when reporting and calculating emissions. So with the introduction of this mandatory reporting, the impacts to other businesses is not so obvious, I guess, and because it's only coming into play this year effectively, there is what we call intended consequences, and then I guess there's unintended consequences, and I think we're all still probably we will be learning around what those unintended consequences are. But from the outset, what we do know is on the left-hand side is that Group 1 and 2 reporters, so your medium to large organisations within Australia, will be integrating climate risk into their enterprise risk management. So they will be specifically looking at how their businesses will be exposed from a mitigation and an adaptation point of view. So understanding where their businesses potentially will be impacted. So what does this mean for other businesses? I guess, there will be more due diligence across the value chains around how your businesses are able to also operate in the face of climate change, in the face of increased physical risks, in the face of new regulatory requirements. I've noted there human rights is also becoming increasingly a point of reporting requirements, or there's going to be coming from Europe, there's more due diligence required around understanding any harm that's being done in supply chains. So whether you do trade or do business with anyone outside of Australia, particularly in Europe, human rights will be a specific topic of interest. And so again, evidence that due diligence around hiring practices, employment is being done is really important. Emissions intensity, again, coming back to carbon, it seems to be it's the first place we all need to start is understanding carbon emissions. The Australia has quite firm targets now, 2030, 43% reduction, 50%, 2050, there'll be a net zero, and these targets are happening all around the world as well. Climate is now part of strategy, so this is a requirement that climate must be form part of the business model and its strategy. So how is climate change, or how are low carbon products and services being introduced to your business, and that's quickly sort of transforming, I guess, the availability around and preferences for customers that are now demanding new new products that are fit for purpose in a low carbon world. Carbon reporting across the value chain. This is just going to be the norm, and it's happening quite quickly. So going back to that previous slide, if you recall, in terms of the group 1, 2, and 3, by 2030, all companies that fall into those three groups will be reporting in full and having full assurance across all of those aspects of reporting. So that means in the next few years, we're going to see some major changes and around companies looking to collect information, looking to incorporate climate into strategy, engaging with their value chains around what can you do to help us reduce our emissions. And then this target setting is part of the requirements as well. Not that you're required to have a target, but because there's legislative targets, but also there is a sort of a market expectation, a competitive advantage. So companies will be looking to do that. And so they'll be looking to their value chain where most emissions are for many companies will be sitting to reduce their emissions. So there will be this all in industry kind of movement around, well, where can we go? And there'll be new trading partners emerge out of this, and organisations looking to switch up who they work with as a result. So I have some Q&A for my support team here. So first one to you, Nathan, if you can come off. So with this introduction, particularly, we know this is coming into effect for larger companies, but I know being in the regions and you working with smaller companies, how is this going to affect the small agribusiness clients, and particularly through the supply chain pressure, lender expectations as well. The banks, we've talked to them about this and what they're looking to do. And also that market access, I think, is really important. Any comments that you can provide on what you're seeing, I guess, at the coalface?
Yeah, thanks, Kath. It's an interesting area. Obviously, it is quite new, and so it's just starting to feed through to the coal face, as I probably on the ground with the farmers, and their requirements that are being put upon them. We've got some wine producers at the moment that are exporting wine into Aldi in the UK. They're actually getting asked for their electricity usage. Obviously, because the UK are doing the same reporting, I think they're a little bit further advanced than Australia, like with most of these initiatives. But so they're having to report how much of their electricity is being used in their wine production. So that's just another reporting element that they need to come with. I've got some truffle producers where they're actually getting some feedback from France that if, in the next 1, 2 years, that if they don't have their carbon footprint with them, they're not going to be able to get the product in the door. So we're starting to see the push come from our group one, group two providers, and it'll go through. I think the next part more locally is with our banks, and the banks having their requirements. They're going to have to ask for some information from the farmers and their clients. It's going to be interesting to see how they deal with that on a one-to-one basis. There's been some talk about using some estimations, but
Yep.
I feel as if those estimations are in the early part of those years where it's the limited assurance, and as they're going to have more assurance on their information, they're going to have to get more specific information. I also see from a farming perspective and a client perspective is that I might be doing something better than the farm next door. So do I want my carbon footprint to be estimated on what Joe Bloggs is doing next door when I know I do a better job in that? And how does that affect me? So there's still a bit of information to come there from the reporters, but yeah, it's starting to have an impact already.
Thanks, Nathan. And Nikki, what are you hearing from where your point of view?
Yeah, look, we're certainly seeing these requirements starting to trickle down to farming enterprises. And even before the Australian reporting legislation was in place, we were seeing, as Nathan mentioned, those international value chains requiring more and more information of our suppliers. So I think that will become much more prevalent in the domestic market as more organizations are required to report. And beyond that, obviously, the banks are now factoring emissions data into some of their lending decisions. We've got industry groups like Meat and Livestock Australia putting together sector level targets. So they've got a 2030 carbon neutrality target in place. So sort of all the roads are leading towards farming enterprises needing to have this emissions data as a minimum. And further down the line, looking at targets for actually reducing their emissions and reducing their sustainability impacts. So I think now's the time to definitely start thinking about getting your records together and getting your carbon account produced so that you can start to look at where can I make those changes and how can I get on the front foot for those sort of future requirements.
Excellent. More questions to come, but we've just watching the clock. So let's just talk about, I guess, carbon emissions. What are they? And I know for some this might be elementary, but for those that are on the call that haven't sort of ventured into this space, your carbon footprint essentially equals what we call scope 1, scope 2, and scope 3. Scope 1 and 2 is what you have control over. So essentially, this is all what happens within the operational boundary of your business. So anything you burn, any electricity that you use. Carbon, scope 1 and 2 can be a little bit more complex for agricultural businesses, but I'll touch on that in a moment. But scope 3 is your value chain. And so whilst you're as a potential small business, your focus really should only be on your scope 1 and 2. Scope 3 is for these big businesses who have to report your scope 1 and 2. So this is kind of this great connector we called it, is what's going to bring us all together, is because for RSM, our scope 1 and 2 emissions is very, very small, but our scope 3 includes our clients' emissions. So it becomes it's the elephant in the room in terms of how do you go about collecting all these emissions from all these partners and suppliers, and understanding how complex the world is in terms of widgets. it does become quite the exercise. But in these early years, the plan or the focus should really be for those for all companies to essentially calculate and get their scope 1 and 2 emissions right. So for scope 1, it's direct emissions, so that released into the atmosphere as a result of fuel use or natural processes. And so for the natural processes, does include in agriculture the biogenic, meaning that those that are coming from the digestion in animals or the decomposition in organic matter. And so that means different things for different animals, and I'll flash that up in a moment. Scope 2 is your indirect emissions. So simply put, probably the electricity that you use. And so when you put it all together, including the biogenic, this is the type of data, depending upon what you actually run on your property, whether it's livestock, chickens, cropping, horticulture, different information in addition to the fuel, electricity use will be required in terms of understanding what your carbon emissions are. Nikki, did you want to add anything to that? No, all good. So coming back to this elephant in the room, the scope 3, and this is essentially where small businesses do fit in. So for example, this is Coles' own operations here. They have to collect information anywhere sort of downstream and including upstream as well. So customers, recycling, end of life, distribution, etc. So they have and banking as well. They have to actually collect all their emissions from all the clients that they finance. So essentially, this is why it's becoming so important that everyone in the market starts collecting and calculating their emissions, not just because you're being asked for it by a larger organization, but also there is value in your emissions. There is opportunity in understanding your emissions, both from an energy efficiency point of view, but also from a new business opportunities point of view as well. So when we think about what carbon does mean for farmers, we think about a number of things. And because the market is going through this energy transition, what it does mean is that there is big demand for land for a variety of reasons. There's demand for land for carbon farming because fossil fuel companies are required now to offset their emissions due to the safeguard mechanism, and increased demand for offsetting, whether it's for voluntary purposes, but we'll be seeing an increased demand for carbon farming going forward. Renewable energy is we're having to deploy large amounts of renewable energy to meet the targets going forward. So we will be seeing areas that will be required solar, wind, and that's for carbon mitigation, obviously. And then critical minerals, an important part of the energy transition is obviously the minerals that are required for battery storage, batteries and wind turbines, etc. So these are sort of the hot industries going forward where it does have an impact on farming clients because they do own land where critical minerals can be found or where renewable energy could be deployed, and carbon farming. But we won't be talking about renewable energy or critical minerals. We'll focus on carbon farming, and this is where I'm going to hand over to Nikki. Thanks, Nikki.
Thanks, Catherine. So as Catherine mentioned, there are a number of competing land uses in Australia, and it's important that we balance those interests across the landscape. We do have limited productive land available here, so it's important that we use that for its highest purpose, which is predominantly going to be agriculture. But it is possible to balance agriculture with carbon farming and biodiversity to actually improve your farming system. So a number of landholders have successfully demonstrated that carbon farming can be integrated into their operation to not only create a revenue stream, but also to improve soil carbon, provide shade and shelter for livestock, manage erosion, manage salinity, attract beneficial species for pest control. So there can be benefits as long as you look at it like any other commodity and make sure you fit it into that wider farm plan. Another factor to consider when thinking about carbon farming is how that works in with your business plan. So what will you do with the carbon credits? So you can either sell them as an income stream, you can keep them on your balance sheet, or you can look to retire them to reduce your own internal emissions. So that might negate the need to purchase carbon credits in the future if at some stage you're asked to become a low carbon organization or even carbon neutral. So there's a lot to consider in that space. Next slide, please, Catherine. So in terms of carbon farming that we're seeing in agricultural landscapes, there are three main types that we're working with. So there's soil carbon, which requires you to choose one or more eligible management activities to undertake on your property. And they can be things like reducing your stocking rate, applying rotational grazing practices, applying nutrients, or retaining your stubble. And all of those activities are intended to increase your long-term soil organic carbon levels within soil. The plantation forestry method allows you to earn carbon credits for starting new timber plantations. So you actually grow the trees and then you periodically harvest them for timber. Or you can also earn carbon credits for changing how you currently operate an existing plantation. So there are a number of different schedules under that method that can work for new plantations or existing. There's also the reforestation by environmental planting method and the afforestation methods that allow you to plant new native trees as permanent forests. So you can do that in a variety of configurations to suit your specific circumstances. You might decide to plant a block of land, a block of marginal land, and just put it all under trees, or you might want to plant belts between paddocks, and there are different ways of doing that within these methods. There's also other methods within the agricultural space, like managing effluent and savanna fire management. But these are the most common ones we're seeing. And we're also waiting with very bated breath for the introduction of the new integrated farm and land management method. So that will allow a landholder to run a variety of different carbon operations within the same project. Next slide, please, Catherine. So I'll quickly run through this slide because I know we're getting low on time. There are a number of different considerations to bear in mind when you're starting to look at carbon farming. There's obviously financial commitments in terms of doing your feasibility studies and then setting up your project, but also that longer term reporting and monitoring required as part of your project. There are a variety of regulatory issues that you'll need to ensure that you're compliant with, including making sure that your land is eligible. It can be quite a complex area, so you may want to look at getting in some experts to assist you with setting up your project. That might be through a fee-for-service carbon service provider or through a partnership arrangement with a service provider who have a carbon credit sharing arrangement. And then the part that I'm involved in quite heavily is the auditing side. So at different points along your project, you'll need an external auditor to come in and just make sure that you're sequestering the carbon that you're reporting on. So yeah, there are a few sort of hurdles to overcome in the first instance and a lot of information to take it on board, but it can be worthwhile in terms of what you can get out of a carbon farming project in that longer term. Next slide, please. Oh, and now we're on to Q&A. Back to Catherine. Oh, you're
Yes.
silent. Oh, you're back.
I'm back, yes. So thanks, Nikki, for that. Appreciate it. I'm just in time. I'm just going to throw one question to Nathan, and that would be just sort of to reflect, I guess, a bit on, your experience working with your clients and that conversation around, starting off, where do I start? What's been sort of some of the issues that you've come across, I guess, from clients, I guess, not resisting, but, the challenges of actually collecting this information? Is it lack of time? Is it lack of the data just isn't there, or they just don't know what they're looking for? And what do you see sort of changing to help clients being able to sort of incorporate or integrate this into their, I guess, BAU, business as usual, at some point?
Yeah. I think the biggest problem is, Catherine, and apologies to all the laymen that are on the phone call. On with you. There's a lot of acronyms. So it's a new terminology that we're working with. So there is a knowledge gap at an operational level. You know, it, it- it's just knowledge, and it's knowledge about the terminology. It's the knowledge about how much, methane a cow produces, and, is this cow the same as that cow? Is the sheep different? There's so many
Mm.
variabilities in it, and I think as we get more farmers to commit to doing some reporting with us and through other providers, then we're going to get more benchmarks and more information to be able to build our knowledge and build the wealth of experience, and get an understanding. And I think that'll be where it goes at the moment. Yeah, just this massive knowledge gap, and yeah, and a little
Yeah.
bit, yeah, unknown and a bit scared.
Yeah, I think that's, from our experience working not just on carbon accounting, but ESG in general, is that, becoming conversant in this new language of sustainability, ESG, the acronyms, and then, but also bringing it back to, well, what does it mean for us, and how are we going to extract any sort of value in it, and why are we wasting our time doing this? And I guess with anything, when in the early stages of anything, it's like, well, it's going to be hard work to start it, and then it's a factor of then maybe the value will start coming, and that will be the access to markets and ability to have the conversations around with suppliers going, well, you have an option for me here. Can I have the lower emissions one? Because that's going to directly, help my story in selling my product onwards. So yeah, that's an interesting take, and I think it just speaks to the where we're at. And I think this probably segues well into just this whole kind of sustainable farming concept, and for most industries, this is can be very, very overwhelming in terms of like going, wow, look at all the things that do I have to do all these things? And the answer to that is no. But I just wanted to point out that, within the Australian Agricultural Sustainability Framework, what falls under that in the first instance, but second, where does emissions reduction or emissions calculation, where does that factor in? Um, but then it's when we work with any company, it's about what we call materiality, and that is working with clients to go, well, what are the material aspects of your business that it matters most, and where you don't actually need to collect the information across all these aspects, but maybe there's only three or four. In the accounting language, we always talk about proportionate to risk and level of effort, and what do you need to put in. And it's important that you don't overbake, because there's no point if there's no value in it. But understanding and pinpointing where in this spectrum that where do your stakeholders, or what do your stakeholders think is important? And so if it's important for your stakeholders, then it's probably important for me. And so with this kind of transition to a low carbon economy or a new sustainable future, increasingly so aspects across this spectrum are becoming more important to your stakeholders, to your customers, to your clients, that will help, that can help escalate and enhance your story as a business, to be able to say, well, we understand why we're doing this and where the value sort of sits. So we would call this essentially an ESG framework, just like you report your accounts with Nathan. We help companies essentially report their ESG or non-financial accounts through frameworks like this. And there's particular specific metrics that apply to each of these different aspects that then become a way to communicate to your stakeholders around, okay, we are measuring our water use and we've found new ways to reduce our water use. We've increased the preservation of certain areas of our land. Etc. Soil health, we've done some soil projects. So again, it's sort of building up a story around your business and around what you're doing in terms of building your sustainability story. Nikki, did you want to make any comments on that, or I guess maybe sort of any comments around, in your experience, auditing these carbon farms? Because there's going to be great opportunities in that space, particularly with the ability to kind of integrate different carbon projects, I guess. What are sort of the key challenges that you come across in terms of between a successful project and a one that's struggling, perhaps?
I think probably the biggest factor would be landholder engagement in the project and understanding of the requirements around the project. So it is a complex space to work in. It's a long-term commitment, so your project might last between 25 years to 100 years. And just understanding what you need to do throughout that process, including what records you need to be keeping, when you need to be reporting, what you need to be providing to your auditor to make sure that they can prove that you have sequestered the carbon that you've said that you have. So I think being very engaged in the project and making sure that you understand the commitment before you go into it is a major part of what landholders should be considering.
Cool. Thank you. All right, we've got 3 minutes to go. So I'm just going to kind of round off the conversation. I do see there's a question. Can you speak to the reversal risk? Is that for you, Nikki?
Yep, I can talk to that one. That's fine. So the risk of reversal is one of those terminology things that you were talking about, Catherine, which is specific to carbon farming. So essentially, the risk of reversal is the risk that something will happen to disturb your carbon project, and the carbon you've sequestered is suddenly released back into the atmosphere. So that might be things like you have a really dry year, your soil organic carbon levels drop, or your trees die off, or there's a fire that comes through and burns some of your trees down. Across the whole of the Australian Carbon Credit Unit scheme, the regulator applies a 5% risk of reversal buffer to each project. So they will keep hold of 5% of everybody's carbon credits for each project. And that bucket of credits is essentially to manage that kind of risk across the program. On an individual project level, there is the possibility of like pausing your project, potentially taking parts of the project out of the project if they're no longer viable, they're not sequestering carbon. So there are a few ways to work around that circumstance if it does happen, but it is an important risk to factor in when you're considering setting up a project. So you need to make sure that you're managing your fire risk as much as possible. You're making sure that you're planting plants that will sustain a drought potentially. So there's a lot of that kind of upfront planning that needs to go into the process.
Thanks, Nikki. With a minute to go, these slides will be made available to everyone that has attended. So we also have some thought leadership that you can quickly, easily, just type into Google decarbonisation strategies RSM and it should pop up there. This is only, I think, about a month old, so fresh off the press if you wanted to grab that as well in terms of understanding what is actually happening across the market around and what solutions are sort of out there. So some good information in there that you might want to grab. In terms of what next, I just wanted to kind of finish off on the key takeaways, and that is sort of accountability, ESG, climate, natural capital accounting is an emerging space. And as we said, everyone is trying to get conversant in this space. There are experts, but there are emerging experts. So, but there is frameworks and methodologies that are out there. The real key here is about understanding that we're trying to get some um, unison around or unification around what we're reporting so that we can actually do apples for apples comparison and that we're all speaking that same language. It's really important. There's no point us all reporting against different frameworks if we can't compare. Disruption is really key. We are in a world full of disruption and a confluence of risks as well, both local and global, that we need to be aware of. And that because we are globally integrated, that something, as they say, if China sneezes, everyone catches a cold. And I think the COVID pandemic was a great black swan event that just shows us that we need to be working together with these global problems. But wherever there is transformation or transition, comes opportunity, obviously, and always to finish on a light note. But there are new markets, there's new opportunities, hopefully all for the best. That is going to improve the world that we live in. But it's going to take an all hands effort. No company can be doing this in isolation. It's going to have to be industry. We need government on board. So it's just something that obviously RSM we're very passionate about, and we're building ESG and sustainability and climate teams, working with our regions to really try and come up with practical solutions around what we can do to help. And I guess one of the solutions we've come up with is this ESG essentials. And this is just to look at some of those key aspects that those material aspects of properties or businesses, at any size that we can apply this framework to, and so that everyone can start talking that same language and reporting on that same information. And that just means that you'll be able to kind of gain access to markets and really talk about the story around how you're integrating sustainability, which is just becoming a business imperative today. And obviously we do carbon accounting as well to help those starting up, and then also those that are obviously looking to do decarbonisation opportunities as well. We can help there. But otherwise, just like to thank my colleagues, Nathan and Nikki, for joining me today, and thanking everyone that was able to join our webinar today. Happy to take any questions post. You'll have our email details, and if you want to reach out, we'd be happy to talk. So thank you, Nathan, Nikki. Thank you everyone for joining, and we'll see you on the next webinar.
Thank you. See ya.
Thanks.
Thanks very much, guys.